Hello, everyone. Welcome to today's Practitioners Insights webinar on climate risk and insights from regulatory stress testing for asset allocation decisions, hosted by CFA Institute. First and foremost, a very warm welcome to our audience from around the world joining us today for a discussion on a very engaging and timely topic. And I often wonder, this is a personal experience, how much role climate plays in investment decisions and how much understanding people have on that. There is a huge gap I notice often. It's a great time for us to discuss that more, and that's why this event. I'm Pankaj Sharma from CFA Institute, and I will be the moderator of today's webinar. I lead capital market policy for CFA Institute in India, and in my role, I'm responsible for advocating policy positions on a lot of stakeholder related issues, including asset allocation, ESG, retail investors, and lot many more. Before I introduce our speaker for today, I have a couple of housekeeping points. Today's webinar is scheduled for 60 minutes. First, we will have a presentation from our speaker for about 35 to 40 minutes, and then we will take up questions from the audience. Since we'll be leaving ample time for Q&A, please feel free to submit your questions throughout the presentation, and you can do so by clicking on the Q&A icon at the bottom of your viewer and typing your question in the box. I also want to highlight that we are eager for your feedback and want to listen to you on the topics we should cover in the future events. So if you have anything you want us to cover, please send your inputs through Q&A box. We'll consider that feedback. This will be very, very helpful for us to think about how we can make these sessions much more useful for you. In short, we immensely value your feedback, so please keep sharing that. Now it's my pleasure to introduce our speaker for today, Soham Das, CFA. Soham is Associate Director at CRISIL and is a leading expert in climate risk stress testing and has more than 13 years of experience in emerging market equities and developed market distressed assets. He is a seasoned small and middle market equity researcher with a focus on alpha generation and trade management. His investing style includes catalyst investing across corporate restructuring events, including demergers, slump sale, and also business catalysts such as new product launches, new capex, new market development, and capital structure arbitrage, which includes debt restructuring, buybacks, etc., etc. Soham is a CFA charter holder, as you can see, but he's also a prolific writer and writes for marquee business media in India, blending his trademark research and analysis with his picture perfect articulation. A very warm welcome, Soham, and it's a pleasure to have you with us here today. I'm sure that our audience is eagerly looking forward to and will have great experience listening to you. Without any further ado, over to you. Let's begin.
Just give me a second. So I think you can see my screen, right? So
yeah, we can see it. So
thank you. So thank you, Harshad. Thank you, CFA Institute, for giving me this opportunity. And I thank you all for joining me in the middle of a busy work week to listen to this talk. And while Harshad has, while Pankaj has actually given me a very warm welcome and a very gracious introduction. Still, let me kind of add a bit more. I'm Soham, and I have been a quant since 2008, CFA charter holder since 2018, and a risk consultant with CRISIL since 2021. I have had the good fortune of working with prominent hedge funds, wealth management desks, and a few trading front offices. Over the course of the next 30 odd minutes, I'll be trying to make a pitch. The pitch will involve, will try to inspire you to start thinking about climate risk for your portfolios, not from the perspective of values or ethics, or even, I'll not try to guilt you into anything, but for alpha, the hard-nosed focus of alpha generation. My goal is not to turn you into an activist, rather convince you to start thinking about how to price this climate risk. While A lot of what we are going to discuss is going to refer to CRISIL quantitative services experiences. In no shape or form should it be construed that it reflects the official opinions of CRISIL or CRISIL quantitative services. All views presented here are mine. With that said, let me introduce you to the structure of the talk and CRISIL quantitative services going forward. The conversation will be actually broken into four major parts, 4+1, conclusion being the fifth one. I'll be introducing you a bit about CRISIL and trying to kind of motivate, I set up the motivation of why climate risk, and why climate risk stress testing for that matter. As we move from that topic, I'll try to kind of move into the climate finance side of the things, that how does climate risk and financial industry and the economy as such is linked. And then I'll try to motivate the need for climate risk stress testing. I'll be concluding this conversation with uh, what can alpha generators do? What can asset allocators do? And hopefully, if time allows us, then I'll be having a dedicated 5 or 6 minute conversation covering about what we sitting out in India can actually work out with. So without further ado, let's move on. When we hear the term, the name CRISIL, we most of us think CRISIL to be the gold standard of ratings in India, and rightly so. But we are also much more, a lot more. We have a thriving risk consultancy business, and we kind of service the entire end-to-end of all quantitative risk services offering, be it market risk, be it credit risk, be it counterparty credit risk. We even engage in very significant amount of fundamental research for hedge funds and for buy-side plans. In fact, the credentials are on the screen, but uh, I'll just draw your attention to one particular fact that I personally am very proud of. We count 19 of the largest banks in the world and more than 100 plus buy side clients as our clients. And they, in turn, consider us as a partner of choice when it comes to servicing their quantitative needs. So that is something that I'm really chuffed about. And we are a truly global company. We have offices in London, Amsterdam, Zurich, New York. APAC, we are significantly in the APAC region, across India, APAC region, Australia. We have roughly 2,500 consultants. And we also are one of the largest employers of CFA charter holders, CFA aspirants and charter holders in India. So yeah, with that said, let me move on to the next one. We have also a wide spread of services for our asset managers. While this looks like a very busy slide, I want you to focus on the solid blue box in the middle of the screen. That is stress testing, something we are going to talk about a lot today. Our climate risk offerings roll up to this, and our clients consider us as a tier 1 stress testing services provider. So the question is, why climate risk really? I mean, why should we be bothered about it? What kind of a damage are we really looking at? What kind of a risk are we really looking at? Why? That really is the question. Well, for us and for many of our clients who approach us, climate risk is appearing to be the fastest growing source of volatility, uncertainty, asymmetry, and convexity. I mean, take a look at the numbers. $69 trillion of economic value at risk by 2100. $183 billion of damages that has happened last year in US alone through physical events. This is the fifth year in a row where the sum total of damages has exceeded $100 billion. So trillions of fossil fuel assets are at risk of being stranded, and roughly $1 trillion of worth of global fixed income assets are at risk today due to the climate hazards. I mean, beyond a point, these numbers don't even make sense anymore. It just numbs us because in the event of such numbers, how do we really process it? However, I would like to kind of draw your attention to the bottom line, three key ideas. And it's a jarring bottom line, really. So the first idea is that our foundational tools of finance are breaking down. We just don't know how to price it anymore. All the models that we built all these years have been based on our understanding about how risk really behaves. And this is one kind of a risk where we don't have any history about. It has never really occurred in the memory of the human civilization, and much less the memory of modern finance. Climate risks do not really creep up on us in a slow, grinding, halting manner. A lot of economists and investors kind of expect cliff events to to be there, which kind of induces a lot of volatility for us. We have always seen how assets behave when they miss earnings, or when they kind of experience cliff events. Investors struggle and scramble to price it. So think of that kind of stress event multiplied by hundreds of thousands. I'm not quite sure how much, but yes, it'll be there. And the problem is that climate induces the volatility at all time horizons. In the short term, it kind of creates these acute physical risks. For example, it creates drought, it creates hailstorms, it creates heat waves. In the intermediate term, it forces us to take a lot of carbon mitigation strategies, which is otherwise called transition costs. And in the long term, if we do not really take those transition costs, in the long term, we will experience a lot of systemic decay in the returns, because the assets will be so much prone to climate risk. And the worst thing is, it's a systemic it's a systemic risk. You cannot really hedge it away. So yeah, this is where we are coming from. And in this context, stress testing becomes important. This is the core of what we do. And the question really comes in that what is stress testing really, and how does it help us in climate risk? Well, it's a forward-looking assessment. That's the first thing. It's a scenario-based assessment. That's the second thing. And what we do is we build scenarios, bespoke scenarios, and subject financial institutions' assets to those scenarios, and we assess how much of risk, how much of losses they will incur. There are two major pathways, and I'll be covering it in a little bit more detail later on. But for the sake of the conversation, there are two major pathways through which climate impacts us. A, physical risk. Whenever we talk about the wrath of God, the fury of nature, the image that comes to your mind, that is the physical risk. Cyclones, droughts, hurricanes, heat waves, those are physical events. And they impact our GDP, they impact firm productivity, they impact household consumption patterns, you name it. The second pathway is to mitigate so basically, the costs a society incurs to move from polluting economic organization, economic setup, to a net zero, low carbon economic setup. That cost comes in the form of transition risk. So when the transition risks are orderly, everything is nearly hunky-dory. We do not really have to pay the bill all at once. We can pay the bill of transition risks, over a longer period of time, little by little. But when it is disorderly, we have to kind of move into a low carbon scenario, low carbon economy within the next 2, 3, 5, 6 years. Then then that bill is going to come to us all of a sudden, and we'll have to pay that bill. So it puts a lot of stress on the firms. Firms can go bankrupt, households come under distress, unemployment rises, inflation rises, and all those things. So this physical risk and transition risk kind of interacts with each other. If we take transition risk now, then we will be able to mitigate the physical risk. If we take transition risk in a later date, physical risk may blow up. If we do not take physical transition risk at all, then physical risk will always blow up. So that is basically the idea, and that is how the two risk legs work in tandem with each other. Having established climate risk, stress testing, and all of it, I want to kind of go back to one quick question actually. We have seen this movie before, haven't we? A few years back, uh, there was a lot of noise about ESG. Isn't this a rehash of the same old thing? And to which I will say that that is the first disconnect that we investors and the finance industry as such is right now seeing. We are confusing climate risk with ESG. My humble submission to all of you is that we should start thinking about climate risk very differently from ESG. Why? Well, it's a risk versus values dichotomy. ESG is about values, ethics, shareholder pressure, checklists, scorecards, sometimes even reputational risk. But climate risk is nothing like that. It's about forward-looking scenario risk, which handles the risk measurement through hardcore fundamental analysis. Let's be clear, many of you have dealt with ESG before, and we see a certain cynicism set in among the practitioners. That's okay. I'm not here to talk about those aspects. This is about technically value and not values, specifically portfolio value, book value, and its probability of destruction. Climate risk is solved not by backward-looking measures, but we solve it through fundamental forward-looking assessments. It's about companies with having a silent hidden time bomb on their balance sheet. You, as CFA analysts, financial analysts, you already work on unearthing those kind of liabilities. The goal now is to just widen our scope of investigation and focus also on assessing the climate angle to it. If there is a climate liability, then it will go off unless diffused early. And point is, the funny thing is that there's a lot of alpha to be covered over there. And my belief is the next wave of contrarian investors are going to emerge from that. But right now, there is a disconnect in this world, and this is the first of the three disconnects that I'm going to talk about. I want us to particularly focus on three key ideas. A, emissions is a negative externality problem. And Economics 101 says that externality can be only fixed by either taxation, for example, something like a carbon tax in this case, or coercion bargains. Secondly, the cash flows get impacted, not necessarily the cost of capital. And thirdly, because there are all kinds of cliff effects and fat tail and long tail nature, nonlinear nature of the risk, our intuition suggests that contrarian investing strategies can work really well over here. Which brings us to the second and the most powerful disconnect. There is a fundamental disconnect between the pace of policy making and the pace at which the risk is crystallizing. It is not that the financial industry is exactly immune to climate risk concerns, but our constraints must be shaped by the policy first. And there's a massive disconnect over there. I won't really harp on this slide a lot, but I'll leave you with one important idea. The challenge is not just that the political leadership is not able to make up its mind, but rather even economists are unsure how to value these carbon mitigation investments. Specifically, the debate is whether such carbon mitigation investments are pro-cyclical with the GDP or counter-cyclical. If it is pro-cyclical, then the equity risk premia, the risk premia of those mitigation strategies will be positive. Hence, the net present value of making those investments will be lower. However, if they're counter-cyclical, that means when the GDP kind of goes down because of recessions, the carbon mitigation strategies really act as an insurance and prop up and support the GDP. If that is so, and that means that it is counter-cyclical, it implies that it acts as an insurance against downturns. That means its risk premia is negative. That means its net present value of making those investments is higher than otherwise. There is this fundamental disconnect, this philosophical disagreement, and some countries and regions are taking the counter-cyclical view, like Europe, and there are countries like US who are taking the pro-cyclical view. As a result, there's a disagreement risk that is coming up. And this disagreement risk kind of feeds into the third disconnect. And the third disconnect is the difference between the climate risk and how we price it. And because we are not able to price it, anyone who is actually paying attention to these dislocations, there's alpha to be made. There's a lot of academic research to show that markets across all hues and colors and flavors are struggling to price this carbon risk. Equity markets, they're struggling. Real estate markets, fixed income markets, even insurance is actually struggling to price it properly. But again, this is not really a problem only about the market and its pricing ability. Our pricing models are also broken. And I told that this basically is a kind of a risk that has no history. And our existing models were built for a world that was linear and with a history repeats and rhymes kind of a mentality. But that is what it is. We mostly are staring at a world of hurt. And I'm sorry for using such strong words, if I can put it like that. Having established these disconnects, I propose that stress testing, because it is a forward-looking kind of an idea, bypasses most of these weaknesses. But especially for asset managers, it is even more important because it unveils the various ways the investment signals get jumbled up due to the climate risk. A second problem is also this, that when we are able to assess the climate vulnerabilities of any of our positions and compare its crowdedness of that trade, we are also in a position where other fire sale actions can affect our portfolio values. If someone else is panicking and they dump their assets, our portfolio value goes down. So there's a risk management angle to it. So climate risk stress testing helps us handle both, to understand how our investment strategies are getting messed up, and B, how our risk management strategies are getting impacted by other people's actions. And this is important because this kind of helps us understand the deficiencies in how we can actually better manage our portfolio. There are 6 sources of bad news really for our asset managers. One, we talked about our normal asset allocation models, be it Black-Litterman model or be it otherwise, is woefully inadequate to handle something like climate risk. Convexity, number 2. Small changes in the taxation level, the one that we talked about, the carbon tax level, is having enormous impacts on EBITDA for certain select industries. And the industries are common. We know it. Oil and gas, power generation, utilities. This is almost akin to having an off-balance sheet item, off-balance sheet debt in the form of climate liabilities. That's number 3. And the converse is the resilience of, of any firm is an unpriced intangible. Why unpriced? Because we just don't know how to price the scenarios that is yet to take place. And the fifth is the most important part. The sectors that we normally considered as defensives during a market correction, those are often the sectors which have significant climate tail risks. And now we are basically kind of nowhere to hide. And that kind of leads us to the sixth problem. Just like there are black swans, the common term in the world of climate finance is there are green swans. Swans, as in like black swans in the form of climate risk, is green swans. We have always seen those cliff events when a stock price kind of dropped 30% in a day or something like that. Those are something called man overboard moments or Minsky moments. We all understand how the investors kind of scramble to make sense of what happened, what is happening, and how to react to it. Now think about that on a global scale or on a national scale at a much larger level. So these these 3 points kind of these 6 points rather come together and completely impact our investment signals. We've been talking about climate risk for quite some time without quite doing a lot of justice to explain in detail about the different components. I did touch upon the physical impact and the transition impact time, but let's revisit this with full vigor. The hard physical events like cyclone, droughts, flooding, that is a physical event. The physical risk side of the thing is something that happens when we are not able to cope up with the temperature rise in the atmosphere or in the climate. As a result, the climate kind of sheds that energy. Thermodynamically, that is how it is modeled. And I will not really bore you with the details by those climate events, especially the precipitation level, precipitation related events like hurricane or hailstorm and those kind of things. Transition risk or transition cost is a cost that a society bears to transition from a high carbon economic production system to a low carbon intensity economic production system. I did talk about this part that if we do this transition in a hazard manner, then there will be a lot of stress in the household, social, and firm and business level. And as a result, the government finances will also get short. So it is important that we transition in an orderly manner. The graph on the top of the slide basically shows that if we kind of keep at it, keep the way we have been emitting the greenhouse gases, we are going to reach a 3 degrees centigrade temperature rise compared to the pre-industrial era, that is 1870 to 1900s roughly. However, if we go down to net zero by 2050, 2060, then we will be able to cap the temperature rise to 1.4 degrees centigrade and thus avert physical risk completely. So there is no free lunch. Either we do nothing now and pay the bill at a later date, and so perhaps our next generations will pay that bill, or we eat the bill right away and insulate the next generations to come from any such climate change issues. So as we speak about the climate risk, I will actually try to kind of briefly talk about how the climate risk is modeled. But to be frank, for asset managers, I'm actually kind of covering a bit differently the style in which we do climate risk stress testing. So it is a matter of curiosity rather. So I'll not really do a lot over here. So the idea is this, that there are 3 layers in which the emissions converts into into the environmental variables, and then it converts into economic impact, and then it converts into firm level impact. So the first layer is integrated assessment models, which basically are complex models which use the emissions and the rise in emissions to model the temperature increase or the increase in sea levels and these kind of environmental variables. The second layer is the modeling and the assessment of transmission channels, which use the output of the integrated assessment model and convert it into the macroeconomic variables. And these transmission channels can be something like a rise in sea level disrupts ports, damages the ports, and it disrupts the supply chain, changes the price levels, and creates inflation. Or something like a prolonged heat wave kind of puts a lot of consumption shock and changes the consumption patterns of the households, leading to GDP loss. And once we have these kind of macroeconomic variables, it comes down to the sectoral and firm level modeling to kind of assess what the losses will be. Now, the first two, let me pull up the laser pointer. The first two layers is common across the is common across the financial industry. So, and because it is complex, so there is value in centralizing it. And organizations have come up that do this exactly the same thing. So Network for Greening of Financial System, NGFS in short, is one such organization and is comprised of financial institutions who are deploying significant amount of resources to solve climate finance. Its mandate is to do these two steps and one meta step. The meta step is to understand and model how the scenarios are going to pan out when we react to the changes in the climate emissions or climate change, and and how does climate change and how does the climate itself react to our actions. So in turn, there is a policy aspect to it, and then there's a climate aspect to it, and then there is an economic behavior aspect to it. So on your right-hand side of the screen, you see a couple of scenarios that NGFS has come up with. You can see that there is net zero 2050 over here. This is the most orderly and desirable scenario where the transition is done in an orderly fashion, thus keeping the transition risk capped and the physical risk in control. Then there is another scenario, which is a delayed transition, where suddenly the investor community, the households, the government is kind of has a sudden wake up call where they say that we have to transition it quickly. And as a result, there's a lot of stress on the system, on the economy, and we have a lot of bankruptcies. We have a lot of we have a lot of failures, firm failures, and maybe rising unemployment and growing inflation. And as a result, there's a disorderliness to the overall economic activity. But we are still able to kind of keep the physical risks in check. What happens when we do nothing? Well, we are in this place where it's a hothouse world. We take no transition risk and wait for the physical risks to blow up. We use these scenarios to kind of simulate how the firms will behave under these situations and what will be the losses around that. I'll skip this for a moment. I'll basically kind of I'll basically kind of cover it if I have some time later on. But as of now, I'll skip this. And basically, in briefly, we kind of help a large bank conduct the CRST on climate risk stress testing on its banking book of $530 billion. This is the this brings us to the elephant in the room. How do we really, asset managers, conduct any stress test for our portfolios? To which I say you have it a bit easier than the credit funds and the banks. The chief way by which non-credit portfolio managers are going to exposed to this climate risk is through the market channel. Uh, Brown and polluting portfolio securities can experience a sharp decline in value. Sophisticated funds build their own version of the carbon index, a proxy to assess market preferences for polluting assets. So basically, what we do, I'll cover this. Basically, what we do is we, in the universe of investable securities, we sort the companies by their emission levels. We take the top 10% emitters, we take the bottom 10% emitters, combine a portfolio and subtract their returns. And that kind of tells us how is the market really liking or disliking the polluting companies. Once we have that, we combine it with the pharma French factors and we do a regression. And then we kind of play around with those indices to shock the values and assess the losses. I do suggest asset managers to evaluate their portfolio after this step 1 to 3 has been done to assess the fire sale losses. What happens when there is, you know, all the other peer portfolio managers also dump the same assets? What happens to your portfolio losses if you hold on to your assets as well? So that is called the asset fire sale losses estimation. This is a bit complex, and while it is very much desired, it's an optional. Uh, I'm taking you back to the CFA level 2 syllabus over here. So what we have over here is the traditional pharma French factor, where you have the market risk premium. Over here, we have the size premium, we have the value premium, we have the momentum premium, we have the profitability premium, and we have the investment style premium. So when we regress our portfolio or our assets, be it a firm level asset or be it a portfolio, with these factors, then we get these sensitivities. And these sensitivities are the traditional 5 factors. What we suggest is we create a carbon index, just the way I kind of mentioned, and we add that into this regression formula, and we kind of regress our returns around that. What we get over here, beta C, is the carbon beta. And carbon beta, we will quickly see that plays an important part in how to hedge our portfolios. I talked about the carbon factor construction. I'll not touch upon it. Uh, and this is something that we used to construct the PMC factor, PMC implying polluting minus a clean companies factor. That is a carbon index factor. For US asset manager, we kind of used this ETF called XOP ETF, which is the combination of all oil and gas companies, which are polluting and high carbon emitting companies, and subtracted its returns from the SMOG ETF, which is basically a low carbon energy ETF. And as a result, we get carbon factor index. This is a very cheap and robust way to build a PMC factor. And when we regress any target portfolio with this carbon factor, we get something like this. Your beta kind of undergoes a swing over here. So it is not really a constant, but rather it waxes and wanes with the way the market kind of treats it. And this kind of offers us a way to trade around this. So with having said that, I'll talk about that later, but this is a regression of the XLE ETF, which is the sum total of all oil and gas companies in US with the PMC returns. And we see a good fit over here. So for us in the emerging markets, we will have to construct this PMC carbon index on our own. And given the fact that we have right now a much more, a much more deeper availability of data with us, I think it should not be a big challenge for us to do it on our own. And this is exactly the kind of insight that we used to construct something similar for a EU-based asset manager. So the asset manager approached us to kind of help them basically hedge their transition risk exposures. They were especially concerned about one important thing, that there is no clear-cut kind of demarcation between clean firms and the dirty firms. The polluting firms were often the most prolific investors in transition innovation. And then there were clean companies which had polluting subsidiaries. For example, a technology company having a data center as a subsidiary. So the idea was, how do we really kind of handle that when everything is a combination of various polluting and clean factors? So what we did was we created this polluting minus clean factor. That is one thing that we just talked about. We also use machine learning models to scan through the news items to construct a climate policy uncertainty index. Uh, I'll not really go into the details of it, but rather when we kind of construct this uncertainty index, we saw that the bonds perform very differently in the run up to a climate news. And once the climate news is digested by the market, the bonds of polluting companies fare differently than the bonds of green companies. So the overall idea is that you can actually work with the bonds and equity in a similar manner, uh, and you can construct a covariance matrix for that. So, with that said, I'll now delve into the insights that we asset allocators can actually take away from this conversation, and how can we plan for climate risk per se. Uh, well, there are only a couple of things we portfolio managers can do to enhance or at least protect the portfolio in the light of the climate risk. PMs must now mandatorily start doing climate risk stress testing. They have to start moving away from the traditional risk metrics to something like a stressed bar or even a climate adjusted bar. We have to start talking about climate neutral portfolios. If there is a company with a positive market carbon beta, then we can hedge it with a company which has a negative carbon beta. And negative carbon beta implies the cleaner companies. And we talked about it. Uh, we should start exploring contrarian investing strategies around these dislocations. ESG works on an exclusion basis, whereas climate risk adds nuance to it. So there is a factor where we can pick up companies for cheap who are investing in uh, innovation, green innovation, yet they're polluting themselves. So they have a better performance by the climate risk standards than what ESG is giving them credit for. And secondly, I'm going to talk about this in a little bit more. Uh, we should trade in cat bonds. Uh, so I'll talk about that, but yes, this is the renewable energy certificate market in India. It's a bit broken market right now, not much liquid, and we do not really have a lot of ability to trade it. But there is a possibility that with growing efficiency, this market will also become a good investment opportunity for us. And for those of us who are actually uh, interested in the climate economic policy, we should actually start thinking about how to structure the REC markets better so that in India they function well. And I'll not go through each one of them, but I'll briefly touch upon a key problem, in my opinion. You see this third point, asymmetric impact. This is something that bothers me a lot. Not every sector will get impacted, and in our experience, not every effect will be equal, and there's a lot of path dependence to the process. And this kind of forces me to really think hard and long about how am I going to kind of build portfolios of my own. And this also kind of forces us to invest at least some resources to develop asset allocation models from scratch. keeping climate risk in mind. And this is where I wanted to kind of talk about. I was hinting about carbon beta and cat bonds before, but yeah, uh, we trade the carbon beta factor. That is one way the fund managers, savvy fund managers, are actually generating alpha from climate risk. Carbon beta fluctuates with climate news as the climate beta cycles, as the carbon beta cycles through through a trough and a peak. You trade on the basis of that hedge ratio. You short the PMC factor, you go long on the asset, and you will still make a profit, and that profit is because that carbon beta actually fluctuates. You also invest in the firms beaten down by ESG exclusion, but carrying a lower carbon beta. So because ESG works in black and white, we can actually work out and have some value investing strategies going on over there. And I think cat bonds actually reflect the most promising of investment opportunities right now for market for investors. India right now is exploring and is in advanced talks to issue its own cat bonds. And cat bonds in general have actually offered very strong returns, as you can see. They generally are priced at the level of triple B minus, but they have superseded those returns. And finally, green innovations, you bet on firms, even if polluting, on their green patents, hoping that they will make the transition. And you trade around the policy jumps. I'll just give you two examples. There is evidence that statistical arbitrage across the policy jumps leads to 4 to 5% of annual excess return. And secondly, and more importantly, from an Indian perspective, that when we trade around the policy jumps and you bet on the greenification of otherwise beaten down companies, polluting companies. For example, there were certain CFC manufacturers in the Montreal Protocol who got beaten down. They turned out to be massive multi-baggers as they moved away from the banned R12 CFC chemicals to the cleaner alternatives. So if we are able to kind of trade around this policy jumps, you can make a lot of alpha around it. So what's the takeaway really? What changes tomorrow? Uh, so the idea is either you price the climate or it prices you. There are only three truths. There'll be jumps. Risk is local, so granular analysis is a must. And pay attention to the cat bonds. Pay attention to the insurance-linked security. Two asymmetries. Margins are convex. Small changes in policy is impacting certain sectors super linearly. And secondly, there is a massive chance of physical risk and transition risk impacting together. As a result, we will be steering at a massive world of losses. So with that said, I'll just move on to the questions, ideas, and thoughts. However, I'll just have I'll just take 2-3 more minutes of discussion over here. I'll basically talk about India a bit, and over here I'm going to touch upon what are the recent movements in the Indian policy space over here, so that we can actually kind of take something away from the perspective of India. So the first thing that we see in Indian sector is well, in COP26 2021, we made a commitment of making a 500 gigawatt energy generation from renewable energies. And slightly 4 years later, on 10th November, Bloomberg ran a story which reported that India has started curtailing solar energy from flooding the grid. Now, for a country that has been perennially energy starved, this is equally a celebratory moment as well as flashpoint. But then the curtailment rate for solar power plants has now reached 12%. What it really means is that our grid, for the lack of a better word, has stability issues. PIB press release of Ministry of New and Renewable Energy itself kind of concedes that over the past 2 years, policy attention at the highest circles have shifted from mere capacity growth to system design and system stability. And we believe that there is a considerable opportunity over there. $36 billion to cut losses and modernize discoms. There is a conversation going on at the highest circles that the state discoms must either list or privatize or bring in a private operator to manage their operations. And that kind of leads to all sorts of new and interesting ways to play this transition that we are witnessing. There is a lot of work going on in the transition stability, the transmission and distribution stability. And we know for a fact that many multinational companies are commanding very rich valuations around it. And that is primarily because of the huge opportunity size that appears in front of them. But there are also opportunities at the bottom of the pile. And this is a great place for a CFA analyst to kind of look under the rocks and uncover new opportunities. So with that said, there is also another 2.4 lakh crore or about $30 billion outlay to integrate about 500 gigawatts of renewable energy from the renewable rich states like Rajasthan, Gujarat into the grid. So the power evacuation projects that will imply that there will be a lot of investment in the energy corridors, green energy corridors. There'll be a lot of investment in HVDC, and there'll be a lot of improvements in the grid operation. So you should be basically paying attention to anyone who is making SCADA systems. You will be who is making EMS systems, and so on and so forth. So with this, I kind of, I'm done. Pankaj, over to you. So yeah.
Thank you, Soham. I think it was fantastic. And I think,
Thank you.
of course, the entire presentation was great, but I loved that term green swan. Uh, like honestly, I heard it for the first time because I'm much less familiar with the terminology as you would be. But it was great, and I was wondering whether we should call it green swan or we should call it red swan because like it might imply different things. But yeah, but honestly, like it was a great presentation. I think the tools which you explained talked about and the India scenario we touched upon. I think it was very, very useful. So
Thank you.
I'm sure that the audience would have also found it very useful. I would request the audience if there are any questions to Soham, and if you want to know further on any particular topic, please send across. There is a Q&A box on your screen, and you can type out your questions there. And but in the meantime, I will also uh, ask you something, Soham. Like there are
Yeah.
a lot of situations when, let's say, if we want to relate this entire thing to what's happening in India, uh, do you think that the it's already there? Whether investors would uh, attribute the price differential or the valuation differential or the stock price performance to a particular phenomenon, especially climate. But that might be there, might not be there. But it's something which investors are already pricing in. For example, when you look at a stock like Coal India, the valuation it trades at. Like 6 to 7% dividend yield has not
Yeah.
done that badly, but still investors are not that interested. So do you think that is something which is there? We might not attribute it to climate per se, but investors know that this is something where you have a little bit of a different situation, and those characteristics will probably ensure that it's trading where it's trading today.
Yeah. Yeah. So good point. Think of it like this: that right now the 5-year risk-free rate is about 6.5%. So add a premium because the way it is exposed to it is exposed to the carbon risk. So market is in a way kind of assuming that it will incur a significant amount of investments to kind of transition to a low carbon kind of an economy. Now, as a result, what's really happening is that perhaps the market is kind of discounting the cash flows much more heavily, so leading to about a 6% extra kind of a risk, sorry, discount addition. So basically kind of, if you kind of assume that the discount rate is 12 to 13 to 14%, then you kind of understand that 7 XPE where it is coming from. So how do we really kind of process it? Now, you're right, the dividend and all those things kind of play. So what I would say is this thing that we can do a carry and hedge kind of a strategy. We do own it, but we hedge it with a clean company so that we are actually carbon neutral, and we pocket the dividends. We pocket the value factor if we need to. So that is one way we can do it. The second way is this, that we actually check if what is the way the abatement fact the carbon abatement and the carbon mitigation transition investments it is undertaking. The way I understand is it is actually investing quite a bit in green methane and green hydrogen as well. So now what really we have is a unique position where it is excluded because of the ESG factors. However, it is making investments in the green transition. As a result, as we talked, those firms, even if polluting, they have lower carbon beta than otherwise. So you can actually kind of invest in that aspect as well. So so, so it requires a bit of creativity and contrarian mindset to think about these things, even from the perspective of a climate risk aware investor. For a value-based investor, value-aware investor, perhaps it is a slam dunk. But even for a climate-aware investor, it is not exactly not exactly a very rich trade to make.
Great. I think
Yeah,
this is fantastic, Soham, because the way I see it and the way you explained is like you have to first accept that there is something which is playing here, and then you have to decide how you will
yeah,
probably incorporate that, what tool
yeah.
you would use, and but amazing. Thank you so much.
Thank you.
There is a question from Param Lodha, and his question is that as you mentioned that
Yeah,
global losses in the climate risk insurance is piling up,
yeah.
how can it be seen as a viable business prospect? Uh, Over to you, Soham.
Yeah. So it it so I'm not in the business of basically uh, uh, calling out. So let me put it like this: that it seems a bit harsh to make a profit out of someone's misfortune, but market and the market ethics do not work like that. Market ethics is that if you actually pay attention to something, uh, the risks kind of in a reflexive manner go away because everyone's attention is on that. So governments kind of also work in a certain way to abate that risk. So what do I mean by that? So for example, because the global losses are kind of going up, reinsurers are issuing a lot of catastrophe bonds. Now, what are catastrophe bonds? Catastrophe bonds are basically a bond that is issued by an insurer who sets out certain parameters. Like if there is a typhoon with a air pressure drop below this level and having lasting for this, etc., 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 then it will be called a trigger. And once the bond triggers, you as an investor lose the entire principal amount. And till the moment that doesn't trigger, the reinsurer keeps paying a monthly, quarterly, or annual dividend, coupon rate, rather. Now, cat bonds have got a lot of attention because it allows the insurers to hedge against this physical risk, even at least in the short term, and you to kind of make money because most of these triggers that has been come up in the cat bonds are so onerous that they are not being met, at least in the short term.
Makes
It so
sense.
happened that Hurricane Beryl came and hit Haiti, and unfortunately, this is kind of a dislocation, and that has to be kind of tackled. So it created a lot of damages for Haiti, but the cat bonds didn't trigger because the air pressure didn't drop below a certain level. Now, what really happened is the investors made money, and As a result, what has happened is that a lot of interest has piled up, and insurers are now able to kind of do a lot more, issue a lot more cat bonds, and they're able to kind of insure a lot more of physical events than otherwise. So even though it may seem like we are benefiting from someone's misery, but we are not really. Market works in unintended consequences and through nonlinear ways, and that is how it is. So that's one way. The second way is this, that when we actually, when there are losses, what we do is we try to basically kind of sidestep those kind of vulnerabilities. And as a result, you either kind of, sidestep by not taking those assets, which ESG exclusion does, or being tactical about it, which this discussion kind of talks about. So this is basically, the two yin and yang of basically, how you at least gain some alpha out of it.
Thank you so much. I
Yeah.
wish we could continue with this conversation, but I'm answerable to Harshad and the team. So we are already past our closing time. But thank you so much, Soham. I
Thank
think
you.
it was insightful, and I know this is a much abused term, insightful, but it was honestly very insightful to
Thank you.
listen to you. And this is such an important and relevant subject in today's times, and for all of us it was very, very useful to listen to you. And as a reminder to our listeners, please do complete your evaluation survey that may have appeared on your screen at the end of the session. And CFA Institute, CFA Society India members may also claim their professional learning credit by logging in their online professional learning tracking tool. This concludes our Practitioners Insight webinar on climate risk and insights from regulatory stress testing for asset allocation decision with Soham Das, CFA. Thank you once
Thank you.
again, Soham, and
Thank you.
thank you, audience, for participating. And see you in our next webinar, hopefully very, very soon. Take care and good
Thank you.
rest of the day to everyone. You will please disconnect now. Thank you so much.
Thank you.